Good morning, everybody. Alan, hi. Good evening.
Hi.
Alan, we wanted to talk about dividend stocks, value stocks, and
Currency weakness.
currency weakness, US dollar weakness.
Yeah. I
Okay.
so actually the two of the themes that I think we're going to talk about today, themes, they're constantly, and we're going to revisit them. We've talked about them in other fits that we've done, and we're going to keep revisiting them because they're constant issues that come up with clients. And one of them is about having trying to find income and specifically dividends from stocks or from indices or from sectors, and how that really has been difficult to do over the last 10, 20 years, but certainly comparatively with what the market has done. It's maybe not, dividend stocks have maybe not performed badly, or they've not lost money, but they've not performed as well as, I mean, when you see some of these graphs, you understand there's huge underperformance, which makes the reason for buying dividend stocks, it's useful, it's obsolete. So we're going to talk a little bit about it. So basically we've got dividend stocks. Clients are always looking for income, especially those that are getting towards retirement or in retirement. And they're looking for income, which has become, and I don't want to get into, bank deposits and other kind of low risk investments that are just not paying any dividends at all. I'm going to focus on stocks that should be paying dividends or have paid dividends, and actually are paying decent dividends. The problem is that capital growth on those stocks is not nowhere near what the broad market is doing. And so there's a huge opportunity cost by putting money into dividend stocks that we're going to cover. And it covers pretty much the whole gamut of sectors. We're going to start off with AT&T and Exxon and looking at both of those because those are kind of stable foundation stones of most American, at least, and many international investors that are looking for dividends. So we've looked at, if you look at AT&T over the last 10 years or so, it's basically flat. It's done nothing, but at least it's paid a dividend. But if you look at Exxon, it's down 50% almost. I mean, that's horrific. So you've got maybe some decent dividends. I think Exxon is paying 3 to 5% dividends, but you've lost half your capital in that time. It's important to at least be aware that just because they're paying good dividends doesn't necessarily mean it's something that you should be getting into, especially if you're retired. I think some clients need to maybe look a little bit more aggressive at what they're investing in at that time, and focus less on actually good dividend income that might see major capital depreciation over a long period of time, which is really bad news for them.
Right.
So,
Okay.
I mean, that's compared to the Nasdaq, which of course the Nasdaq is going to outperform, very high risk, very volatile. But even if you compare it to the S&P 500 over that time, the S&P 500 has doubled in value in 10 years, and Exxon has gone down by 50%. That's an incredible outperformance.
Yeah, I think the next graph we have here, this one of Amazon and Alphabet, and then even just the tech index, right? And then how that is just killing the pro shares S&P 500 dividend aristocrats, right, which are the leading performers typically on the S&P. How they've been decimated by these tech related indices or tech shares. So you can see that in this chart, right?
Yeah, I mean, actually, the next one I wanted to talk about was financials, because a lot of
you can see that here too.
Yeah, there's a misconception also from a lot of retirees or people approaching retirement that if you invest in financials, banks, very stable, great dividend paying, and that did work at some point in the past, but it's not worked for the last 10 years, and I'm not sure it's going to work in the next 10 years either, because we're going to have a continual low interest rates, at least for the foreseeable future. You have bank crisis after bank crisis, which actually has had, in some cases, you have governments or federal central banks, for example, actually preventing banks issuing dividends or at least cutting dividends. Because of the mess that they're in and because of the bailouts that they've had to get from central banks. So it really doesn't work either. I mean, okay, the chart is not as bad as the one we looked at with Exxon and AT&T. It's 127% up over 10 years. So you made a growth of 27%, plus you've got some dividends, but they're not really paying much. I'm just looking at the current dividend yield on XLF That is a current dividend yield of less than 2% right now,
Yeah,
or just
I mean,
around 2%.
these things aren't paying great dividends anyways. That's the whole point. It's like, what dividends are you getting? AT&T pays a good dividend, 7%, but the stock hasn't done anything in 10 years. You just showed that,
And
right?
Exxon pays 3 to 5%. It's averaged
3 to
3.3 to
5%.
5% dividends over the last 10 years, but it's halved in value.
Right. We did a webinar a long time ago, I think maybe 3 months ago on dividends. And when we brought up how much the dividend aristocrats on average paid, it's somewhere about 2.3%. I mean, you're going to invest in these things just because they pay a dividend of 2.3%. It's just not even worth discussing.
And I have a great chart I want to show that it points out that the dividend-paying stocks have enjoyed a performance advantage over non-payers only in small and mid-cap stocks, but overall, especially in large companies, it's not the case. And I just want to.
I think we looked at that earlier. Was the dividend the mid cap 400? I think it is, or something like that.
Let's go through some more of these charts you brought, Alan.
So we can come back to that. Energy is another one, which again, we've looked at Exxon, dividend yield of 3 to 5%, but the performance is terrible. We looked at Alerian, we've looked at MLPs in the past, and these have great dividends, but they're really struggling. So I mean, there are dividends out there, but you're not going to find them in traditional, the IBMs, the Exxons, the AT&Ts. The General Electrics, the General Dynamics, those kind of companies, they're going to struggle, I think. So there's other areas we have to look. We looked, I think, a little bit at Amazon and Google, but there's also traditional tech stocks, which I just mentioned there with IBM. And again, current yield 5.6% on IBM, but it's really, really struggling. Broadcom, Texas Instruments, Qualcomm, these are very, very typical.
Techie stocks.
They're almost institutionalized stocks. I mean, these are veteran tech stocks. If you look at Broadcom, just ridiculous outperformance. Texas Instruments, great outperformance. Where's IBM over the last 10 years? It's down 18% in 10 years.
Yeah.
But it pays a good dividend, though. Focusing on the wrong thing, guys. Really, that's. I mean, I don't.
It's funny that this chart brings up Broadcom, Texas Instruments, and Qualcomm. These are the ones that
we have a structured product.
Our clients love to do structured notes on, because if you did these on these, all you have to have is the thing go up a little bit, and you make money over 3 to 4 years. But we can make notes on these that pay 18.5% income. 18.5% income on this. So these are huge dividend. If you structure them through a structured product, you can make these into huge dividend paying instruments.
The other thing which is really going to impact all of these kind of stocks that have paid dividends is dollar weakness. Because we've gone through a period, and it's been generally, the last 10 years has been generally very strong for the dollar. We may be getting to a period going forward for the next few years at least, where there's definitely the dollar is in a weakening trend. How much we're going to talk about in a second. And I don't know if, Chris, if you can bring up a couple of charts, just GXC is one. So that's a good way to play dollar weakness. You're not buying, you're still using your dollars, but you're buying assets in a different
China.
Location, which are based in renminbi or yuan, for example. We also looked with a couple of clients this week at CYB, Chris, if you can bring that one up, which is actually all it is you're buying Chinese yuan deposits. That's it.
There's a currency play, pure currency play.
It's a pure currency play. You're buying bank accounts basically with dollars, but that's the trend line. What is that, 1 year, Chris?
This is a 1 year chart.
So last 6 months thereabouts, you've seen a one way direction straight up.
Yeah, this is since May. So 12% or something.
You can buy these with dollars. There's no reason to go and open a yuan bank account in Hong Kong or in Shanghai, or
I think the ease of which people can access foreign markets, the ease of which people can access foreign deposits and currencies now, it's just really incredible. There's none of this, oh, I need to actually convert my money into something else. No, just position it through a
Exactly.
vehicle, through an instrument. You want to bring up that article that one of our clients showed, Alan? I think that's a good article. The FT, yeah.
I mean, this was the basis of a number of discussions this week, where I think Citibank came out. One of the traders and one of their analysts came out and said that they would see a 20% depreciation in the dollar against a basket of currencies.
Mr. Calvin said.
Yeah, the problem is that, as we've just discussed for the last 10 or 15 minutes, most of the great opportunities are in dollar-based stocks or in dollar-based instruments. Now, you can buy NEO, you can buy Alibaba, you can buy Tencent in America, but are they dollar assets? No, they're Chinese companies. You can buy Ericsson in America. It's a Swedish company, so it derives its income in krona. But again, most of these companies, like Coca-Cola, I can't remember, there was a figure, 24% of Coca-Cola revenues are US based. Therefore, 76% of revenues are not US based or not US dollar based.
You can have access to these assets that are actually deriving their revenues in foreign currencies, non-US dollar currencies, and still participate without ever changing your portfolio, really. I mean, just buying a different company or something. I mean, I wanted to point out here in this article, I think the whole article boils down to one statement. And if the U.S. economy performs well, right, then the dollar can weaken. But what they're looking for is when people start looking for higher returns outside of the U.S. and they begin to exit this, what they call the U.S. safe haven. The U.S. safe haven is deposits in U.S. dollar bonds. I think those trades are pretty much over the minute the COVID vaccine comes in. I think what's going to happen then is people are going to look for assets within the U.S. market system that you can get on. And we've covered some of these in Telegram. We've covered NetEase and some other companies in China, even NEO and NIU and all these little Chinese electric vehicle companies and stuff. These have no revenue in the United States. They have no business in the United States. They have no business in U.S. dollar, really. So you're getting access to that just by purchasing some stock in a foreign company. There's no need to. I don't think overall investors are at the point where they're going to be like, oh, now I need to look into changing my money into emerging market currencies or worry about these things at all.
Bitcoin. They're going into Bitcoin too.
Yeah, and Bitcoin was 17,000 this week or something. I mean, that's the way to hedge your bets if you really want to go somewhere. But
I mean, but again, all you're doing with Bitcoin is you're buying a non-dollar asset. You're not investing in anything.
Hoping the U.S. dollar does fall. That's all you're doing. That's the only way to make money on Bitcoin.
But well, exactly, and the same way as gold, really.
I was going to look at gold real quick, and we've had this discussion. We thought gold was breaking out here, and it looked like it was, and then it came right back in and couldn't hold, and now it's sitting right here on this line of support. I'm really, you just don't see any value in gold. We don't see any movement in gold and gold miners. You just don't see anything, and if this falls and breaks down, this could be, a good short here. So I don't have any interest in gold. We haven't had any really interest. We've been repeating that story over and over for months, I think, Alan, right? I mean, every time you get on, we talk about.
I mean, again, the focus, Chris and Veronica, to sum up, is that people need to focus on asset returns and getting the stock to increase and the asset to increase, rather than focusing on which currency they might be in. It's really difficult to find. We might take plays on the euro being a great place, but you try to find a euro that is going to make a lot of money this year. I mean,
a European company.
I looked last week at some clients that have been in Henderson Horizon European Growth, which is a great fund, great management, great fund. It's done nothing for 5 years or something, and I'm not sure that Europe is in a bit. The Japanization of Europe is something we've covered before. Europe is not the most dynamic place. It might be a great currency going, to be in, but you're not going to make any money on it. So you're better to focus on trying to make money in dollars. And if you can pick up companies that are making money outside, like Ericsson was a good example. make money outside the dollar universe, if you like, but buy that in the US and in dollars, then I think it's a good place to go to, rather than
And you'd have to look at
just
things like
put all your money in euros or pounds or Swiss francs or something like that. I mean, that's fine if you want a bank deposit, but not if you actually have money invested.
Right.